Most of my money is invested in global index funds and ETFs. And right now, global indices are sitting at record highs. This is the FTSE All World. But look at the Shiller PE, which measures how expensive the US market is. It's nearly at the same level as the dot-com peak. So surely the market is overvalued. And given that we're currently sat at all-time highs, surely now is a terrible time to invest. I don't think so. And I'm going to tell you exactly why. But it's not just global funds, of course. The S&P is also at an all-time high, as is the Nasdaq 100. All of it feels a bit mad, especially when you factor in everything going on, as we like to say, as Brits. I'm not a financial advisor, and I'm not going to pretend I've got a crystal ball and I know what's going to happen. I'm definitely not the Oracle of Bishop Stortford, but I'm going to take you through the data, the sources, terrible joke, I know, the history, the practical things you can actually do, and why you probably shouldn't be too concerned. Oh, that was never going to be a good idea. Very barbecuey, would you believe it? If you are feeling nervous or sitting on a big wad of cash that is calling out to be invested, this video, I believe, will genuinely help you. That one was not very nice, to be honest with you. I really should have gone with the ketchup. But anyway, let's move on. In a perfect world, you, me, we would all buy at the bottom, sell at the top. Wait for the next dip, the next crash, and repeat over and over. Buy low, sell high. It's not rocket science. That would make us a lot of money, and I'm not gonna lie, it would genuinely feel very satisfying, but unfortunately, nobody can do that reliably, especially over decades. And before I get into the data or the sources behind this, here's an honest question I want you to think about. Say the market drops, I don't know, 10% tomorrow. Would you genuinely pile in? Because in my experience, most people wouldn't. They would still feel nervous and want to wait for another 10% fall. And that's the weird psychological thing with investing. When the market's high, we don't want to invest because it's high, like right now. And when it falls, we don't want to invest because what if it falls further? No one wants to catch a falling knife, as they call it. It's a catch-22. There's always a reason not to invest, whether the market is going up or down. And getting past that mental block is honestly half the battle. But you have to be able to, unfortunately, to succeed with investing. This waiting element is damaging and brings a couple of real costs for your money. This analysis on screen from Hartford Funds looked at the S&P from 1996 to 2025. If you miss just the 10 best days over the past 30 years, you'll return more than halves. That's 10 days out of over 10,000 days. If you miss the best 30 days, as you can see, you lose around 84% of the returns that you could have had you just stayed invested. JP Morgan had very similar findings. Miss just the best 10 days, and in this one, your return nearly gets cut in half. Miss the best 30 days, and you might as well have just stayed in cash. And those best days regularly turn up at the most unexpected times. As you can see here, going back to the Hartford Funds research, 76% of the S&P 500's best days occurred during a bear market, when the market was down, or during the first 2 months of a bull market, when the market started going up. So just stay invested and don't try and time the market. Once again,
not exactly rocket science, is it?
I honestly love that clip, but I do appreciate you probably know these market timing stats already, and this is much easier said than done. So let me show you some more sources. I really should have got a better selection, shouldn't I? Since the 1950s, the S&P 500 market has spent roughly half of its time within 5% of its all-time high. How crazy is that stat? And going back once again to that Hartford Funds study, you can see just how bull markets dominate over the long term. So I do think this stat checks out. The market is regularly at, or at least near, an all-time high, which is another difficult mental hurdle to get around when you're deciding whether to invest at all-time highs, like right now. Another stat, in any given year, the market finishes higher than it started about 3 times out of 4. This is the S&P 500 over the last 100 odd years. It is a bit of a different way to look at things, but as you can see, there's a lot more green over the long term than red. Once again, showing the market simply regularly is high and goes up. This applies to global funds too. Although the FTSE All World, a global index, hasn't got as much data going back, this is the last 20 or so years. And this is the counterintuitive bit, another weird mental barrier that we just need to get around when it comes to investing. And I do appreciate, I've said that a couple of times now, but once the market hits a high, it tends to go on and hit more highs. Highs come in clusters. So the gut feeling of it's high, it must be about to drop. I mean, it might, in fairness, it of course will drop at some point. No one can time it, as we said and showed, but history shows it probably won't drop off a cliff. In fact, it's much more likely to do the opposite and continue to go on to new highs. I've thrown a lot of stats and graphs out there so far. An important question is, why is the market often at a high in the first place? Although there are, of course, crashes and bear markets, over the long term, bull markets dominate. The simple answer, over time, companies make more money. This is called corporate earnings. There can be short-term disparities between corporate earnings and stock market prices, definitely, but over the long run, that is the main fact that drags the market up. This chart from Banker on Wheels show this for the S&P 500 over the last 30 odd years. This chart from Macro Trends shows it over an even longer period. And why do corporate earnings keep rising? It's ultimately because companies make more money, because humans keep getting more productive and innovative over time. And this is a quick side note, but this is really why you do need to be a slight optimist to be successful with investing. You have to believe that things are going to continue to get better for humanity, for the world, as that will then result in higher stock market prices and hopefully more money for us as investors. The main point here is that new highs aren't necessarily a warning sign. Highs are very normal, even though the media often do make a big song and dance about them. Okay, this all sounds well and good, but the big question you probably have is, what if I do invest today, right at the top, just before the market crashes? Maybe you are looking to start investing today, or you've got a massive lump sum you've come into and you're sussing out whether to invest it or not. I'm not going to lie to you. If that did happen, you invest right before a massive crash, that of course would be a massive nightmare. But the key point I want to make here is that it probably won't derail you as bad as you think. The actual data on this is nowhere near as scary as the feeling. As you can see here, and this is for the S&P 500 once again, between 1950 and 2025, investing at an all-time high has historically given you returns roughly in line with investing on any other random day. And this data, when it says only all-time highs, includes some of the worst times ever in history to invest. Black Monday in 1987, the dot-com crash of the early 2000s, the global financial crisis of 2008. Of course, your returns are slightly lower because you've invested at the peak, but it's not a night and day difference. So even if you are so unlucky that you keep investing for whatever reason at every peak, don't play the lottery. Over the long term, you're still not that much worse off. Using the same data of the same source, the S&P 500 has had 1,325 all-time highs over the last 8 or so decades. And this is up until August 2025. So there'll be even more now, given how 2026 has been going so far. That works out to be around 16 per year across the 80-odd year period. Of course, there are some rough decades. Here you can see in the 1970s and the 2000s, and this actually aligns to the chart that we showed earlier on in the video. But in the following years and in the following decades, the market once again bounced back. These pie charts are also useful reference points to hopefully settle the nerves. They show that a market correction of 10% or more after an all-time high is actually relatively rare. Listen, of course, there is no way of knowing what is going to happen, but history tells us that the market tends to move higher over the long term. And new all-time highs aren't necessarily a warning sign to wait to invest or to pause your current investments. So if you have got a lump sum of cash sitting there, should you put it all in now or drip feed it in? Historically, putting it straight in as a lump sum has beaten drip feeding about 2/3 of the time. There's a lot of data on this, and here is one of the pieces of research from Vanguard UK. They found that lump sum investing performs better around 2/3 of the time on average, and the longer it took you to invest a lump sum, the larger the opportunity cost of that money. Now, this is actually a very interesting point to make. The longer your money is drip fed in, the longer a chunk of it sits in cash on the sidelines, so the more you lose out on essentially. That is the opportunity cost of not investing and keeping your money in cash because it's losing out to inflation. But to be honest with you, the gap between lump sum investing and cost averaging isn't really make or break. The real gap is not investing at all and leaving that money sat in cash year after year, waiting for the perfect time. I think this graphic that I found sums it up pretty well. So if drip feeding is the only way you'll actually invest because you are nervous, which is understandable, or because you think the market is high, or for whatever other reason, honestly, go with that approach because it's much better than keeping your cash sat there doing nothing and losing to inflation for years. The only thing to genuinely caution you about here, panic selling. I genuinely think one of the biggest risks of investing is investing right at a peak, the market soon after falling, that person panic selling, thus locking in that loss, and then thinking the stock market is a scam and never investing again. That is one genuine investing disaster to avoid at all costs. And this is something that genuinely would derail a person's long-term investing and financial goals. Now, this all sounds well and good, but this time is different, isn't it? This is a very common pushback, so let's look at the current situation of what's going on. By a lot of measures, the US market is very expensive right now. The one many people point to is the Shiller PE or CAPE ratio, CAPE. This compares prices to 10 years of earnings. I'll put the graph back on screen. It's around 42 to 43 as I record this. The long run average is much lower at around 17. The only time it's been around these levels was the dot-com peak in 1999. And of course, we know what happened shortly after that. So surely this time is different and there is a cause for concern. This time, maybe investing at the current high is actually a bad move. And to be honest, the reality is that high valuations have historically meant somewhat lower future expected returns. But this Shiller PE is just one way to value the market. The forward PE, which measures how much investors are willing to pay today for every £1 of a company's future expected profit of the S&P 500, is around 20 times. This makes it high-ish compared to historical norms, but nothing too out of the ordinary, as you can see. For the MSCI World Index, an index that tracks developed markets and not solely just the US, has an even lower forward PE ratio, right in line with historical norms. So the honest takeaway, is the market overvalued? I genuinely have no idea, and no one else really does either. It depends on what metric you use, and of course, none of them are perfect. It's always easy, and I find this all the time, to look back in hindsight and say, oh yeah, at the peak there, of course a crash is going to happen at that moment. But when you're forward looking, it's just impossible to predict, no matter what metric you're using. Some metrics will have Messi as the best footballer of all time. Other metrics might have it as Lord Bentner. Maybe that's pushing it too far. Okay, fair enough. But you know what I'm trying to say. Amazingly, this metric from Morningstar says the US market is undervalued. So yeah, who knows? The bottom line is no one truly knows whether the market is overvalued or undervalued. And the point here really is that expensive markets can get even more expensive by these metrics and stay there for years and years. The market can stay irrational for years. And there are so many things that go into dictating whether the market will go higher or lower in each day and in each year. So this time is different. Maybe, maybe not. I've got no idea. Which brings me on to the next point, market crashes. And when we say this time is different, that's how people often try and say a market crash is going to come, the worst one of all time. Now, of course, market dips, crashes, corrections, they usually happen when the market is at a high point. The thing with the market falling, even with these massive crashes that we experience, is that the market will crash. It will 100% crash. And unfortunately, it will crash over and over again. A market crash is a matter of when, not if. This chart is perhaps a little overwhelming, but over the last 150 years, there have been around 19 bear markets, drops of 20% or more. That's roughly one a decade. And the hard part about crashes is that no one knows when they will happen, how big they will be, or how long they will last. But I think mentally, if you know that they will happen, then hopefully you can feel more comfortable and are less likely to panic sell, which is that big risk that we want to avoid. And most importantly, in every single case, the broad stock market has recovered from every crash and went on to new highs. Don't get me wrong though, there have been some difficult periods, some difficult decades when investing. On screen are a few of them. And I think when you are investing, you have to be prepared that potentially at least a handful of times in your investing career or journey, your money is going to lose a lot of its value, particularly if you're 100% in stocks and stay down, be in the red for years until the market recovers. I will come on to some of the practical things you can do so you are prepared for this shortly, but I think ultimately knowing this data and the history can hopefully help to put your mind at ease a little bit. And just to reiterate a previous point, it's always easy to explain a crash afterwards. Looking forward, it's genuinely impossible to call it. I'm also not immune to this either, by the way. Honestly, there have been times I've been genuinely nervous because the market has been high and I see all these media headlines. But honestly, I look back now and wish I just ignored it and invested more. But you live and learn, as they say. My biggest mistake, and I've spoken about this before on the channel, was trying to time the market in 2020 during the big pandemic crash. The market bounced back almost quicker than it ever had before, and I missed out on gains that I could have got, but instead I had money sat in cash that I should have invested, and I didn't invest it because I thought the market was going to fall more. So practically, what can you actually do? This is what I would say as the bottom line. And this assumes that this is money you're investing that you won't need for 10 years or more. You have a long-term time horizon. And it assumes that your investments, your asset allocation, matches how much risk you can actually stomach. Get invested and keep investing every single month, no matter what. Time in the market beats time in it. If you've got some cash or got a lump sum sitting there, putting it in straight away has historically won about 2/3 of the time. But if drip feeding it in over a few months or even over a year is what gets you to actually do it and makes you feel more comfortable, then honestly, just do that. It's better than simply leaving that money sat in cash, losing out to inflation. Don't panic sell if there is a crash at any point. The single biggest risk isn't buying at a high. It's buying, watching a dip or a crash, deciding the whole thing's a scam, and then selling at the worst possible point. And that turns a temporary fall into a permanent loss and might make you fearful of ever investing again. And hopefully through this video, you feel much more comfortable now investing at all-time highs, so you won't be subject to any panic selling. Stay globally diversified. I've been banging on about global index fund online for 7 years now, and this is something that I didn't speak about in the main content in this video. Normally, a lot of the data points and sources are US focused, as there's more data available for the US market. But I do think now more than ever shows the power of being globally diversified across all countries and all company sizes. And just once again to reiterate, this all assumes that you have a long-term time horizon of 10 plus years and your assets, your mix of stocks and bonds, or whether you're 100% stocks like myself, actually matches to your true risk tolerance. That was a big video, but I hope it was all helpful. And the thing is with headlines in the media, they're always going to dramatize things and make it sound like the sky is falling. So the question is, should you invest at all-time highs? For me, with money that I'm not touching for a decade plus, the answer is basically always yes, and it always will be yes. Get invested. Don't panic when it dips or crashes. That is completely normal, unfortunately. And if you are 100% invested in a global fund, the unfortunate reality is that there probably will be a few times where our money drops by 20, 30, maybe even 40+%. That unfortunately is just the nature of investing. But if you know it's coming at some point, hopefully you can be better prepared for it. Another concern that investors often have is that the market is too concentrated. Too much is in the US. If you're thinking that, watch this video on screen here next, and I go through that in a lot of detail. There's a lot of sources in that one too. But yeah, if you are a bit nervous about the market being over concentrated, give that video a watch next.